We're about to start the next panel, and I think this is a really interesting one because RWAs have been tokenized for years, but there's something to be said about added utility, added mobility, collateral mobility, but something that we're really seeing emerging now is DeFi and how that's relating to real-world assets. So we decided, you know what, for TokenizeThis 2025, we're going to have a whole panel on experts that are doing this actively or involved in some way, shape, or form. So without further ado, please welcome the RWA Vaults panel.
This is DeFi Vaults for real-world assets, and I'm the moderator, Camila Russo, the founder of the Defiant, the best source of DeFi and Web3 news, and I'll let the panelists introduce themselves.
Hi everyone, glad to be here. My name is Emanuele Rossi. I lead sales and business development at Mountain Protocol. We are the issuer of a stablecoin called USDM. USDM is the first regulated, permissionless, yield-bearing stablecoin. We simply taken the barrel-tested model of stablecoin issuance from a Circle or a Tether, where you have an asset that is fully reserved, over-collateralized by treasuries. We've applied prudential regulation, and we are regulated by the Bermuda Monetary Authority and bankruptcy remoteness for maximum consumer protection. We've kept the permissionless nature of the asset, meaning that it's composable and can be used across all different type of markets. And then we've enhanced this model with a yield component, meaning that any holder of USDM not only have access to a digital dollar, but one that pays the risk-free rate of the United States government. We pay rewards daily, directly in the wallets of the holders, without any staking, claiming, or anything else. You simply hold the stablecoin and you get paid daily rewards in your wallet. And we really think about ourselves as a financial institution. We're not trying to do anything speculative. We're really trying to bring a better, more productive dollar in the hands of people leveraging stablecoins.
All right, good day, everyone. My name is Jerome. I run Cometh, which is a custodian and crypto-to-crypto service providers based in France, regulated in France and in the EU. So we applied in, well, we run in full compliance with MiCA. So if you have any question with what's going on in the EU, please ask me about it. And we work mostly with EVM networks, and we are able to custody any type of assets that are living on those networks, and especially real-world assets as well. And I was personally, I was doing some things on tokenized assets and the security standards back in my days at Consensus and so on in the past.
Hey guys, my name is Forte. I'm the founder and CEO of Elixir. Elixir is a cross-chain modular network that posts fraud proofs to Ethereum. We are the creators of DEUSD, which is short for decentralized US dollar. We view it as the way for these institutional RWAs to actually enter DeFi. So we have a little bit over 200 million in TVL. We actually allow for holders of these RWAs like BlackRock Biddle, Apollo Cred, Hamilton Lane Scope, to actually one-click mint dollars against their RWAs and actually bring them into DeFi. So yeah, pleasure to meet all of you.
Hey everyone, my name is Kevin Miao. I'm the head of growth at Steakhouse Financial, which is, I think, most relevant to this conversation, the largest DeFi Vault curator on a protocol called Morpho. We manage about 500 million in TVL across those protocols. Away from that, we are, candidly, I think the leaders in RWA in crypto. We just if you may have heard of Steakhouse and the kind of tokenized Grand Prix that we just ran, which we deployed $1 billion of capital into BlackRock's Biddle Fund, Janus Henderson, and a kind of slew of other institutional on-chain tokenized credit funds.
Awesome. Yeah, thanks for the intros. Now I'd like to get a bit more specific on how each of your protocols or companies interact specifically with RWAs and DeFi. Like, what is each of your roles in those ecosystems?
Yeah, for us, as a permissionless digital dollar, we are deeply ingrained across the whole crypto market. This could be DeFi, it could be CeFi, it could be anything that touches stablecoins. Specifically talking about DeFi, there are a variety of protocols where an asset like USDM can be used these days. It could be decentralized exchanges and AMMs like Curve. It could be a lending market or a lending protocol like Compound or like Morpho. And then there are a variety of other flavors and alternatives, whether it's derivatives exchanges and more. The pitch with using something like USDM is whenever you're deploying stablecoins on chain, you are likely going to be relying on a USDC or a USDT, and you're basically paying a hidden fee to these stablecoin issuers, Circle and Tether. With USDM, you can keep running your DeFi trading, your DeFi activities, while capturing the economic incentives associated with the stablecoin program, and basically capturing that risk-free rate. Again, for us, it's not about innovative or bringing crazy risk and crazy type of yields to the table. It's about giving you access to the risk-free rate across your trading operations, and in this case, specifically across your DeFi capital allocation.
So on our end, we intervene both pre and post-emission. Sometimes pre-emission, you have a RWA emitter that has a crazy idea of tokenizing XYZ. And in order to distribute properly, they are looking for a good custodian to be able to efficiently safekeep the asset for the sake of the buyer. That's what happened most of the time. Like we get contacted by real-world asset emitters, and we become the de facto custodian of the initial emission. And some more sophisticated actors in the buying space also have their own custody services. So in which case they give away their own, they give out their own account for the reception of the stablecoin. And we also intervene post-emission, where sometimes at the end of the emission, the buyer gets to say like, yeah, it's tokenized, but where do I put it? You need to have a wallet. Okay, well, I'm going to introduce you to a couple of custodians in this case. We are able to interact with most of the DeFi protocol. So far, we haven't seen much sophistication in the real-world asset owners and holders. But we expect that to change in the future. So we'll be definitely able to say, hey, you want to pledge these real-world assets into Aave or any Steakhouse vault, in which case we are completely able to do this kind of transaction for you and monitor it and act on it if you need to.
Yeah, so RWAs to date have been kind of segmented from the rest of DeFi. And it's been something where it's like, because they're securities, you can't really do anything with them, right? You can't deposit them into like Aave, you can't borrow against them, you can't LP them. Because the fact that like, even if it's like BUIDL or like a wrapped version of BUIDL, like how are you gonna price that asset? You can't, right? And it's like, even if you can and you think it's worth $1 or whatever, like who's gonna actually put liquidity, who's gonna incentivize it? And so that's why these security wrappers have never really taken off. And so our belief at Elixir is that you actually need a stablecoin issuer to come in and say, look, we'll take that RWA. We believe this is worth $1, so we will issue you composable dollars against it. And so that's what Elixir does with the USD. We actually allow for holders to take their RWA, mint dollars, right, like digital dollars. We don't take any fee. You continue to accrue the yield from your actual RWA, and then you can redeem out at any time, right? So we actually store that as isolated backing to where you don't even need to, like, it's not like your assets are being rehypothecated or anything. You can see it on chain. Everything is fully on chain. So that's, I think, the first big unlock. And then there's a whole wave of utility that comes around that. So then, for example, at Token 2049, we're making an announcement with Apollo and Securitize around the first leverage looping using senior private credit on Morpho. So you'll be able to borrow dollars, put it into a yield-bearing private credit fund, which is yielding 10%. And I mean, you're borrowing dollars in DeFi at 4%, right? And that's only possible because of Elixir and because of DUSD. And I think, so we're really just at the very just beginning stages, we're at the first inning, top of the first, and I think it's we're only just gonna keep growing and seeing these use cases.
Yeah, I think for us at Steakhouse, we are, I think, probably best thought of as almost a RWA, on-chain RWA, investment bank. So we will work with projects at the earliest stages if we think that they have unique insights into a particular market, and take them on as a client and basically both engineer, design the credit product, but also the on-chain protocol alongside them and get them ready for launch. And then to Philip's point, a huge reason why most people are trying to launch on-chain, again, candidly, the reason is they could never raise $1 in the traditional financial markets, most of them. But for the ones that can, they're basically trying to play the game of DeFi utility, which is the ability to effectively get margin lending against it via an RWA or a Morpho vault, which we obviously run one of the largest vaults in the world, and so we have some influence over how much utility you can actually get on a token. And then also the second thing is you want to be able to access on-chain capital. So the reason BlackRock, the Apollos, and all of these guys are coming into this space isn't because they have some ideological bend towards crypto. If you're offering them money at a rate that they can't get elsewhere in traditional finance, they'll come to you. And so in a lot of ways, I think we also manage the treasuries for many of the largest DAOs in the space. And so we kind of offer this full suite of, hey, we'll help you design a product, but we'll also help you understand what the landscape of adding utility to your token on-chain actually means.
Perfect. So each of you is really facilitating a bridge between issuers of RWAs and allowing those assets to be used in DeFi. And how to move forward from there? How to make that, how to add volume to that bridge essentially? What are the roadblocks that you're seeing now that is, that are preventing more people from using these various types of vaults?
Yeah, to me, it's a matter of the whole DeFi complex, which spans infrastructure, spans legal, technology, and so forth. In the end, who are the entities or the people that are able to access these markets these days? Very crypto-native individuals and institutions that are comfortable handling blockchain technologies. Now, what needs to happen to take this to the next level? What added value can provide to the market to force people to get into this sandbox? It could be novel sources of yield, it could be novel use cases and applications. For us specifically, we pay a very low rate compared to some of the opportunities that you find in DeFi markets, simply because there is a lot of native dynamics in DeFi, such as points or token incentives and so forth, that really help juice yields. But when you're looking at something that pays the risk-free rate, that to many DeFi traders and investors, it's not really a very attractive product. So what are some of the things that can be done for a company like us? For example, it's building real-world applications and use cases with traditional fintech companies, traditional neobanks, payment companies, and so forth, that now, at least in our case, not only have access to digital dollar through stablecoins, but through one that pays the risk-free rate of the United States government. And some examples that we're building, some products that we're working on is, for example, enabling fintechs in Latin America or emerging markets to bring to market savings accounts, dollar savings accounts to hundreds of thousands of customers that before didn't even have a bank account. So we are looking at it through this lens. What type of new financial products can we create through DeFi markets, through these pipes that are not necessarily only supporting speculation, but real-world use cases and financial empowerment in a variety of regions?
So maybe jumping on what Philippe said just before. I personally see the financial market that we built on blockchain to be very, very dense, very, very mature, and very, very efficient for what it moves. Being automated market maker, being lending protocol, being vaults tokenization, and many different things that you can do with it. What's holding us back is mostly, in my opinion, the fact that real-world assets are barely directly compatible with those kind of protocols. So you have to find workarounds, just like Elixir is doing with DUSD. And you need to give more easier and more efficient access to the traditional actors that are usually holding those kind of assets and could want to make it tokenized and make it real-world asset that lives on the blockchain. And from a size perspective, the amount of value that can move from those legacy actors to DeFi actors is just 1 to 1,000. So there's also a question of how the liquidity that we have currently on the decentralized finance can be put at work and can work normally under such amount of value that will move to those financial markets.
Yeah, and just adding to that, I mean, there's been a lot of supply of RWAs, right? Like you've had whatever, all these different funds, all these money market funds that have gone live, but there hasn't been any like demand. Like there hasn't been any real use case. Like why would I put money in in BUIDL earning 4% if I can't do anything with it when I could just earn that same 4%? I could earn 5% on my USDC in Coinbase, right? And I think things like Mountain Protocol, right, are trying to actually tap into that composability while you're earning that like the risk-free rate. And I think it's like it's things like that I think will be kind of the big unlocks, right? Where it's, yeah, because right now there's all these different RWAs, but there hasn't been a very large reason to put money in. It's mostly just large foundations that say, oh, I want like a bunch of BUIDL, so they just put their treasuries in BUIDL. It doesn't even count as TVL on the chain, right? So it's just like, it doesn't even accomplish that, right? So from a chain's perspective and from a user's perspective, there hasn't been a large draw yet to put money into RWAs, right? But I think that's going to change, right? Like once these use cases start coming live, and you can, like the future is you'll have a portfolio on Robinhood, and you'll have a bunch of whatever Tesla stock or whatever, and you can move that into Aave, borrow against it, and use that for a down payment on your house, right? And like that level of composability, we're not even like close to that yet, but like the vision is there, and like we're heading in that direction. You just need to be able to build the pipes in order to actually get you there.
Yeah, I mean, I think I mean, there are a lot of reasons why I think RWAs haven't had too much take up yet, and that I do agree they'll change. And I think specifically two things. One of them is just the commoditization of the underlying infrastructure that TradFi like kind of takes for granted. If you are custodying assets, like a publicly traded QSIP through a custodian like State Street, you are probably paying a fixed fee, right? It costs State Street the same amount of money to service you, whether you have a $200 million portfolio or a $200 billion portfolio. In crypto, in custody, and Jerome is probably better equipped to talk about this than I am, but like the market is still pricing custody as a percentage in basis points, like 20 basis points on assets under custody. Like that's like there's no operating leverage or no reason why you would buy a tokenized version of that asset if the way that you hold that asset in a compliant fashion, the way that you access it by getting into a stable coin, and you might get charged 9 basis points on the way in. Like all of those fees, when you take a really investor-centric lens towards, forget about what you can do with it once it's on chain, but even just getting it on chain and holding it on chain, it's still way too complex today and too costly. And then the second thing I think as an asset issuer is the liquidity premium in crypto is extremely high. Like because the average, even within a 12-second block on Ethereum, people are doing, 50 transactions, right? So a lot of the movement or a lot of the success of tokenized assets on chain have been in money market funds. They're things that are liquid or have the ability to become liquid through primary redemption in 2 days. But that is, even 2 days is too much. So a lot of the market makers in this space, they'll charge a yield-bearing stablecoin, they'll charge a tokenized money market fund. Hey, you want me to hold $25 million of capital so that I can satisfy a US dollar fiat redemption or a USDC redemption, and I can wait for you to sell the bond, wire me dollars in fiat, and replenish the capital that I deployed on chain to satisfy that redemption? They'll charge 30% IRR, right? And so even as an issuer, it's like extremely challenging to make all of these unit economics work until a lot of this stuff becomes commoditized. Sorry, I just went on a rampage.
Yeah, I have one more comment just around adoption, and not specifically for RWAs, but just integration of DeFi markets into the mainstream. Recently, Coinbase launched a lending product where people are able to take loans against their Bitcoin holdings and receive USDC back. This experience takes place through the Coinbase application that many of people in this room probably have. But in the back, it's powered actually by a DeFi application called Morpho, a lending market. Now, like Philip and Kevin and others said, what happens when you have tokenized stocks on Coinbase, and again, you can take these loans through this very simple interface that are powered by DeFi. That's what people in the industry call the DeFi mallet. Easy, centralized experience in the front, but a crypto-native DeFi experience in the back. To me, that's what you need to bring net new capital to the space, and specifically to the RWAs, you need those type of distribution channels. Otherwise, expecting people to show up with a MetaMask wallet and buy, $1 million of a Apollo private credit fund just because it's tokenized is going to be quite tough for that to happen.
And just to clarify, we don't have an AUM business. So we are one of the few custodians that you can give custody to your funds, and we won't charge you on an AUM basis. But many crypto custodians do so because their infrastructure compelled them to do it. New generations of custodians are emerging where you don't have this kind of constraint. And I feel like what's emerging here is that we all agree of what's great with blockchain is that it brings a lot of moneyness. Once you have tokenized your asset, it's always available, it can always move. I love to say that crypto is like a bearer asset. If you have it in your pocket, if you have it in your wallet, it can move. And it works 24/7. So there's many good reasons to move your assets on-chain.
Yeah, no, great to just highlight that after talking about all the kind of roadblocks that we're seeing. There's obviously, I think, everyone here is probably on board with the fact that blockchains do make financial transactions more efficient, global, and so on. But I think, like a common thread that I'm hearing here is that right now people who are on-chain and crypto native don't really have a reason to use or buy RWAs because, they're more, they are risk takers who are looking for higher returns than what a BitOld fund can give you. And on the other hand, those who are looking for those types of returns are not on-chain. And so maybe they would like to take advantage of having a more liquid tokenized fund that you can then lend and use in a composable way in DeFi, but they're just not that type of user yet. So do you guys agree maybe with Emanuele's point that to get more adoption, we need to get these more non-crypto native users on-chain more easily, maybe with this kind of crypto wallet or DeFi wallet way, just better distribution, will that be kind of the big unlock?
All right. Well, yeah, I think the main things are going to be kind of creating an embedded experience, number one, where it's you can, I think the end user still trying to get them the way that MetaMask currently is, or because when you put money into an RWA, you actually get a tokenized asset, right? And it doesn't usually show up in your wallet. You have to go and you have to add the custom contract address, and then you get this spam token in your wallet, right? And I think if that's kind of where we're starting from, it's going to be pretty difficult to bootstrap a full user experience, right? Ideally, it's going to be through things like the Coinbase, the Coinbase product that Emanuele was mentioning, but where you can just one-click borrow against your tokenized assets, right? I know that Coinbase Wallet has an RWA product already, so you can put money into BitOld and they will actually custody it for you already. So things being able to borrow against it, that'll all just be abstracted away. Robinhood is already, in that example, they're already very pro-crypto. They're looking into RWAs. Their CEO is tweeting all the time about how RWAs are the future. So I think it's only a matter of time before we get into those things. I think that a lot of the complexity comes around, when you're dealing with actual securities, it just gets very complex around okay, how do you actually build liquidity, right? You won't ever be able to sell a BitOld share on Uniswap. That's just not going to happen. And that's just because like, I talked to BlackRock and also just like security and all the issuers. It's not like a secret. You can't put a security like in an AMM.
You can't have it really be permissionless. Like you need KYC, so you can't just like plug into a Uniswap and
there's a $5 million minimum to put money into the BUIDL fund, right? So it's just like you can't have like random people transacting with it, right? So there has to be some sort of embedded solution, which is what I think either through something like a Coinbase, right, where everyone's already whitelisted and KYC and KYB'd, getting into that, or it's going to be something through like these like vaults, right, that we're like building out where you can just like do like looping with Apollo Cred, or it's going to be some other sort of like abstracted away experience where people just are able to press a button and access DeFi behind the scenes. So that's what I think it'll look like.
Look at the if we look back, like RWA are as old as ICOs. Like we started to realize that the SEC in 2017 filed a famous report saying the DAO was actually a security. So it's great that you didn't go this direction with this project. And then for like 3 years as Ethereum developers, we tried to figure out how we could build good standards for securitization. Like it wasn't called RWA back then; it was securitization. So the use case that we thought would win was delivery versus payment. Like you have this security as a security, it's a token, but we deliver it, you get paid, and so on. It didn't really catch up due to many different problems. But now we are ending up in a situation where it's extremely difficult to do the whole cycle of what you expect from a token: listing on a DEX, listing on a centralized exchange, listing on a lending protocol. At the same time, full support of the different wallets, so anyone can access it, and at the same time, figuring out compliance. So compliance is usually the hardest thing to go around, and gladly we have a tokenized vault that can wrap up this compliance in some ways. And once you unlock that, you get back into the different standards that we know and love, like NFTs and ERC20s, and we are able to transact around with that. So I feel like the 24/7 availability of blockchain is already a good reason to go in this direction. Delivery versus payment, like, oh yeah, I get delivered immediately. Yes, you do. But maybe we can go one step further and explain that we are also able to actually prepare the position, transfer the position, and not necessarily clear the position, which is some things that will be, I think, emerging in the next years, where instead of warehousing the assets on a wallet, we warehouse the assets on a contract, and we are just transferring the contract over. And those kind of innovation are at some point going to, put the last nail in the coffin and be like, yeah, sure, this system is just much better. We need to all migrate to this.
I totally agree with both of those points. I've made this point at some, similarly in the past. I also think having just longer duration, lower cost of capital, institutional capital will dramatically change, like willing to invest into assets that are placed on chain is going to dramatically change the landscape of our space. Like all of the private credit funds, Apollo, Athene, right? I mean, even back to Berkshire, Geico, like the innovation in asset management happens on the liability side. Everything is commoditized on the asset side. And so when that basically creates this like artificially low cost of capital in traditional finance that is not available in crypto. And therefore, if you have a great asset, you're looking for the lowest cost of capital, you're going to keep choosing TradFi over and over again until you can construct or engineer the same cost of capital on chain. Theoretically, like over time, like the beauty of I think what we're doing here is the cost of intermediation will trend towards zero in this market, and that's like the pitch, or that's like the long-term vision. But it's going to take a few key steps to get there, because what's the point of a many-to-many like append-only database that has network effects if there's no network of buyers there?
Look, it feels like we are kind of a credible alternative already. So I don't know if the US will end up or not put Bitcoin in the strategic reserve, but we are credible as an industry. people IPOing, people being listed, and so on. So yeah, blockchain is credible. It's credible. It's working 24/7. Okay, and it has no intermediaries a priori. So if you have a custodian, yes, it's an intermediary, but still. So the cost of intermediation today is extremely low in TradFi. But what if the intermediaries goes off? Like your transaction won't go through. Well, if your node goes off, you can run your own and pass the transaction through. So maybe in a world that is more and more unstable and more and more complex to roam around, having a foot in the alternative world is also a good way to continue doing business. So tokenize.
Okay, so we've talked about some of the use cases that have been, maybe slower to take off, but have been the main use cases so far in RWAs, mostly tokenized money market funds. Also, private credit has been an important use case. I'd love to hear your thoughts on what's next. Like some of you mentioned tokenized equities. Do you think that's kind of the lowest hanging fruit, or what do you think will be the next thing to take off or to see demand in this space?
I mean, tokenized stocks have been one of the first RWA as well, together with treasury and real estate and a bunch of different esoteric assets. It's all about distribution and about who wants to buy this product. With crypto, specifically in DeFi, you have certain dynamics that generate different type of interest rates for lending activity and liquidity provisioning on DeFi markets. And those rates, when suppressed, means that participating in this market is not as interesting, especially over the last few years where interest rates were so high. So my view is that there was, yes, an appetite to make tokenization work, but there was also a real use case to providing an interesting rate of return to crypto-native investors. And that's where companies started to basically experiment with assets like treasuries and money market funds. There was a real need for investors to hold a safe asset that generated an appealing return in a low crypto-native interest rate environment. It's one of the most liquid markets in the world. That's another reason that made it easy, and so on. Now, stocks, real estate, and so forth, again, they've been around the block in tokenized formats for quite some time. Why have they not picked up a lot of activity yet? Distribution and the type of investors that want to hold those type of assets are not in crypto at this point in time, at least in the crypto-native camp. Again, why would a degenerate crypto trader buy a tokenized stock at this point in time where it's just a buy and hold type of investment, and when they can do it 10 times cheaper and with less risk on a Robinhood? It just doesn't make sense. If you start distributing these products more globally, and again, embedding it in global distribution channels, whether it's a LATAM type of fintech application or whatnot, then things start to make sense, and access to the product makes sense, but that's not a DeFi experience. That's more a fintech type of experience. There is going to be a point in time, in my view, where, again, the world are going to converge between CeFi, DeFi, and so forth, and you're going to be having these products readily available in DeFi markets and so forth. There is going to be a lot of interesting arbitrage opportunities, in my view, because you have plenty of asset issuers that can bring 10 different versions of the same tokenized stock to the market. So what does that mean for traders and people that are looking to deploy capital and exploit this type of inefficiencies? TBD. But again, for me, treasuries were really a needed instrument when they started to be deployed in the centralized finance markets. The rest of tokenized products are very interesting. There is certainly demand for them. The buyers are just not in that marketplace at this point in time.
So I'm not sure how many people in this room have tokenized a treasury bonds. Maybe some of you have. I feel like it's a bit of child play from a bank perspective. Like it kind of feels like the hood that's hiding the rest of the tree that's hiding the rest of the hood. Like, well, it's just a couple of hundreds of million that have been using to tokenize the French treasury bond, US treasury bonds, and so on. Those are just, for me, experiences saying like, hey, we can tokenize those. Look, it's fine. It's an asset that are safe kept here. We know where it is, and it's living on the blockchain, so we can say it's a blockchain thing. But still, like we've said many times on this panel, like TradFi are optimized specifically for this use case. So why bring this use case into the blockchain? Maybe at some point it will make sense, but so far it's well optimized to do the rest of the thing. I think some of the low-hanging fruit are actually going to come from the art business, like art pieces, like because those folks have been quite evangelized already with NFTs. And they are notoriously having trouble with art lenders right now. So tokenization of those kind of assets, exotic assets, can come pretty fast and be thoroughly pushed by some of the key actors of the system. But the end goal, in my opinion, would be that my kids, when they are 10 years from now, doing their first mortgage, just apply anonymously on a mortgage saying, like, this is my situation, I want to borrow this for that. And then they just borrow it to many people at the same time and repay in stablecoins and then have their house or their car living on the blockchain, at least from the property rights living on the blockchain this way. There's a lot of things that we can optimize from this way, and it's already quite daunting to talk to 20 banks because you want to buy one apartment and you have to get 20 different quotes. At least this is how it works in France right now. So, and I definitely believe this is where we're going.
Yeah, I think as you get down the risk curve, it gets like a lot less attractive to like think about, right? Like I think the tokenized T-bills are like top notch, right? Because you have really good liquidity. We take it and we know that one BIDL is worth $1, and we could redeem it for USDC through Circle. But like as you start getting down the risk curve, right? It's like okay, tokenized car loan notes or like the tokenized like banana field, like you're just like you're like these are things that become like very illiquid, and it becomes very. I don't really see, at least in the short term, those really taking off. I think there's kind of a split between in the RWA space that at least I see from just working in it every day, that like there's already even senior private credit. Like you'll look at like RWA.xyz, and some of these RWAs are like people who put money in and they generated a wallet and they created and they put money, like they're like, okay, I have one BIDL, right? Like that's $1 that is actually like, I count as like a real RWA. But there are like issuers that are just like on the back end, just printing on Ethereum, like one token for each of the holders in their fund. And the people in the fund don't even know like that it's like an RWA. Like that's not even like a real kind of like RWA, right? So I think the use cases that I'm really focused on, I think are things that are going to be high utility, right? So U.S. equities are great. Top-notch senior private credit with like senior private credit obviously is like a lot. The main drawback there is that generally redemptions happen quarterly or at least like monthly, and so there's ways around that where you can go to Galaxy Digital and they're willing to write a put or a call option against it, or you go to one of the people who pulled together the fund that, and they're willing to buy out at 95 cents to the last month's NAV at any time, right? So you have these structures that are starting to prop up where you can kind of get this atomic liquidity but it's only for the top-notch assets. And I think that those are the things that are happening behind the scenes that like most people really don't think about when they're thinking about like, oh, we're going to be able to have like all these random RWAs like on Ethereum. Like it really gets quite difficult to take those, because like I mean we wouldn't mint DUSD against any of those things that I just mentioned, right? Like it's just like okay, BIDL because you can atomically redeem it for USDC, like a cred, Hamilton Lane scope, like these are all things that you can just like very easily get out if you need, but anything else it's like very difficult. So I think they'll have a harder time getting those into DeFi, specifically for the DeFi use case, right? Which is like what I focus on a lot.
Yeah, I totally agree with that, and I think that is probably actually where the people are going to make the most money in this space in the next few years. Is like what Philip just described is a kind of like dystopian version of an authorized participant in the credit ETF universe. And really, what they do is they just they have the ability to like issue and repurchase, like purchase shares at a discount on NAV, like swap it for the portfolio, monetize discount to NAV. Like these things are already like comfortably entrenched in the way that our traditional finance system like provides liquidity for otherwise illiquid assets like bonds within a bond ETF. And that I think that's basically what Philip is describing, and we're seeing the same things at Steakhouse. And because there's so little liquidity to provide to do that, and there's so few counterparties who have the technical capability as well as the traditional like kind of underwriting capability, like whoever wins that market is going to make a lot of money, potentially indefinitely, because I don't think some of these core problems, will be satisfied, but or in the near future. But I personally, I hope that RWAs moves away from just assets and yield and just this constant cycle away of just thinking about real world assets purely as the output, as a yield or a cash flow stream that's generated from it. The reason that this technology is so powerful is because it's a computer. And if you think about all the middle office, back office work that is done both internally in a workflow stream from originating an asset all the way to selling it, how many different intermediaries touch it? How many people rip out some dollars? How many people do you have internally just making sure that the loan tape or the servicing tape matches up with the dollars that you received that month, and so you don't have to go back and have this conversation back and forth? Bringing that workflow on chain is far more meaningful to me than just constantly thinking about what is the asset, because that's only scratching the surface of why this stuff matters.
Awesome, super interesting stuff. I think what we're seeing here is how the infrastructure for real world assets is getting built with these different types of vaults and ways to custody these assets, and kind of on the lines of what you were saying, it's getting these processes on chain so that in the future more use cases can be used, more assets can come on chain, because in the end what you guys are providing are ways for everyone globally to have access to these investments that in the past were only available to a small number of people. So I think that's kind of what's exciting about this space. It's making it more permissionless and more global, and just unlocking assets and use cases that just weren't available before for people everywhere. So thank you so much, guys, for the panel and for the interesting conversation, and thanks everyone for joining us.
Thank you, everyone.